If you don't have a plan, you plan to fail here.
Peter, hello. Good to see you. Welcome back to everyone. Our countdown to retirement continues. Today, we have 4 ways to address long-term care and medical expenses in retirement. So first, I want to throw some stats at you, Peter. According to Fidelity, the average 65-year-old couple will need nearly $315,000 for healthcare in retirement. That's not even including long-term care. Long-term care, meanwhile, is likely 7 out of 10 people will need it at some point. And again, it's not covered by Medicare. So let's talk through our options. The first option would be traditional long-term care insurance. What are the pros and cons of that option?
Yeah. Well, just to preface this, this is absolutely something that we need to plan for. Long-term care is very, very expensive. As you stated, 7 in 10 of us will need it at some point before the end of life. That's according to the Department of Health and Human Services latest statistics. So when you're talking about a potential cost that could be one of your largest costs in retirement, I mean, this can drain an account value. It can lay devastation to an otherwise well-built financial plan if we have not addressed the potential cost of care, long-term care in particular, because again, Medicare does not cover long-term care. So that's why there was traditional long-term care insurance for many, many years. And the pros of that is that this was probably the most comprehensive coverage that existed. However, it is now very hard to qualify for if you've had any kind of health issues. They can be kind of relatively mundane, routine types of things, but the insurance industry, because of the cost of care, because of the prevalence of care, because of the issues that lead to the requirement for care, they have become very, very strict and stringent on approving people for traditional long-term care. The insurance industry really didn't like traditional long-term care. Many of the companies that offered it overpromised, and it was not a profitable product for them. They underestimated the number of people who would need it, the length of time they would need it for, and the cost of that care. So they've gotten out of that business. But for those that still have a traditional long-term care policy, again, probably the most comprehensive type of coverage that you can get for this insurance coverage to leverage your money and protect against these costs. And I've recently been talking a lot about the great wealth transfer, this phenomenon that is getting ready for the baby boomers to transfer their estimated $70 to $90 trillion on to the next generation and their beneficiaries. Unfortunately, the reality is I think a lot of that great wealth transfer is going to end up transferring to the nursing homes and to the IRS because people have not planned for this issue.
Right. Good point. All right. Our second option here would be linked benefits. How does this work?
Yeah. And this is an approach that people have generally found more attractive than traditional long-term care because it is not astronomically expensive. It is not use it or lose it. One way or another, you get a use for the dollars that you are putting in. And you've got a known price. They can't come back and increase the price of your traditional long-term care like they could rather with traditional long-term care with the linked benefits. So the linked benefits, as that name kind of indicates here, is a couple benefits that are tied together. And this is the way that the insurance industry has also moved because they have been able to define their liability better, and people have liked it more because they do get use from the money one way or another. So there's 2 different types of linked benefits here. One is through life insurance, and you are purchasing a life insurance policy that if you never need it for the cost of long-term care, it is life insurance. It will pass on to your beneficiaries as a life insurance benefit after your death, tax-free. The benefit here is that bucket of money that is the life insurance benefit, you can actually advance it to yourself if you need it or want to cover the cost of care with it. And this is structured differently with different companies, but a lot of companies are offering this linked benefit or accelerated death benefit now, where they are allowing the owner of the insurance policy to advance themselves 2% per month or up to 24% of the death benefit per year for a period of time. So you've got some coverage. And if you are lucky enough never to need it, it is that life insurance component. So you can either spend your money and then refill the bucket for spouse or children with the life insurance benefit, or use the life insurance as the long-term care coverage and preserve more of your nest egg and portfolio. The other type is an annuity linked benefit.
Right.
And with annuities, you are guaranteeing the main point of an annuity, like the base that they serve, the purpose is to have a guaranteed type of income. And a lot of these are guaranteed for life. And so you set up the annuity with the thought that you are going to use your money. You are going to withdraw your money. You're going to spend your money. You're going to create income with it. And the provision of the linked benefit or the well-being benefit on these newer types of annuities is that if you ever have a long-term care kind of situation, that income that you are otherwise using and already planning on will be increased while you are having that long-term care need. And this, again, the provisions are different, the nuts and bolts are different from company to company and product to product, but a lot of these are increasing the income by 50 or 100%, like doubling the amount of income while you have that long-term care kind of event for a period of up to 5 years, for instance, or until the money runs out. And Erin, in any kind of account, if you have a long-term care need or any need, and you wanted to pull more money out more quickly, you could do that, right? That part is not truly the benefit, because if there's money in it, I can pull more money out if I need it. But in any other kind of account, if you do that and the balance goes to zero, that's it. You're out of money, you're out of income, you're out of death benefit. With the annuity linked benefit or the well-being benefit, at that point in time, the income is still guaranteed to you for life. So while you may have drained the account balance because you used it for care more quickly, even if the balance is now zero, the base amount of guaranteed lifetime income that you set this up for to spend that money, that still is maintained. That still is paid to you for the duration of your lifetime. So even if you've used up your money more quickly, you still at least have the guarantee of income. And a lot of people, again, one side or the other, the life insurance or the annuity side, are finding this approach perhaps more attractive because one way or another, you get use of the money for the intended purpose. And oh, by the way, it's got this additional long-term care protection that is sort of built in.
Of the 4 options we're going to talk about, is this one your favorite?
I think this one is probably the one that is most attractive and most effective. They're the next 2 options, not necessarily totally fantastic. The first option of traditional long-term care insurance, it's just so difficult nowadays to qualify for it. Very few companies offer it. It's use it or lose it. The prices can increase. And for many people who had those, it did increase on them. So yeah, I think this one is probably the most attractive option with the linked benefit.
All right. So let's get to those last 2 then. Option number 3 would be to simply self-insure, but not only is this difficult for a lot of people, it can be very risky as well.
Yeah, well, I mean, it basically is putting your assets on the table as the protection, right? And so it's great to be able to say that I can self-insure. Like that is a very financially confident statement to be able to make. Regardless of the cost might encounter, I will be able to pay for it. Fantastic. But at the same time, for a very small portion of the growth that those assets likely generate in a year, you can protect the money that is giving you that sense of confidence. And so being self-insured probably is not the most effective utilization of those dollars or leverage. And let me give kind of a comparison here, is that if I've got, call it a $500,000 home, it is not the most effective way for me to insure that home to take $500,000, put it in the bank and say, I'm self-insured. I don't need any further protection. I'm not buying homeowners insurance. That's just not the most effective use for those dollars. I want to pay as little as possible to leverage and protect against the catastrophic event. And so even for those folks who could reasonably say, I am self-insured, most of them enjoy and appreciate that leverage and protection that taking some of these other approaches might be able to offer them to protect the assets that they've worked so hard to build.
Mm-hmm. All right. And our last and final, and perhaps least favorite option, Peter, would be to simply become a dependent. Of course, no one actively chooses this option. This is what becomes our default if we do not have a plan.
If you don't have a plan, you plan to fail here. And there are some families, very tight-knit families, where there might be conversations where more often the most common is the daughter or daughter-in-law. It just statistically becomes a caretaker for the parents or the grandparents or parents-in-law. So that is one case where you become dependent on your family. You live with them, they provide a level of care. I hear spouses say this, well, we'll just take care of each other. I challenge anybody that thinks that's the ideal approach. Go home and pick each other up off the floor unassisted and put each other into bed. It can be very challenging. And there are certain jobs that you don't maybe want your spouse to perform for you when you require this level of care, or don't want your children to perform for you when you require this level of care. So call the kids and ask them, if they mind if you come and live with them for 6 months and maybe even longer. Nobody's excited about that. But again, if we fail to plan, that is the default. Or I hear a lot of people talking about Medicaid and essentially becoming dependent on Medicaid as the fallback for providing whatever level of care and assistance they need at the end of life or when they've got those medical issues. That is not a comprehensive level of comfort that most people would find ideal. It is essentially healthcare welfare at that point in time. You are required to spend yourself and your spouse down to a very low level, essentially spending away all of the assets in order to qualify for Medicaid. And then once you do qualify for Medicaid, the government, who at that point in time is paying for the level of care, gets to decide the level of care that you are entitled to a large extent. So we want to plan carefully. And I think being a little bit more proactive, this is part of like an optimized plan, bringing all the pieces together. You have to plan for healthcare expenses. You have to document what approach you would like to have and who you would like to provide that care and your goals and your wishes, and then take the steps to make sure that you are able to, even if you don't have ideal living conditions requiring this level of care, that you are at least maintaining some level of comfort and quality of life.
Right. Well, and at least having this conversation with you, Peter, it's become clear to me there are many options, some better than others. It certainly would warrant a conversation. And just to remind everybody who's watching or listening today, you have this Countdown to Retirement available as a download on your website, richonplanning.com. Again, walk everybody through how they can get their own.
Yeah, first on the internet, of course, you go to richonplanning.com. That looks like Rich on Planning. It's my last name, richonplanning.com. Go to the resources tab and then to the downloads. And there are a number of resources available to download. One of them is the comprehensive. It is the full packet of the Countdown to Retirement reports. So it goes 10, 9, 8, 7. We're here today talking about number 4, the 4 approaches to long-term care. And all of these, I think, are great food for thought and in consideration when you are planning for your financial future, specifically retirement, looking ahead and want to make sure that you've crossed your T's, dotted your I's, and you've got things covered. So richonplanning.com, resources, downloads, and download your copy of the Countdown to Retirement.
Okay, we have your website. How else can we get a hold of you?
You are welcome to call me. And we do offer a complimentary courtesy review, getting to know you, allowing you to get to know us. And we will put that comprehensive plan together. We call it the Optimized Retirement Plan, looking at income, investments, taxes, healthcare, and legacy, and making sure you've got a plan for each one of those to optimize your path forward. Give me a call, 919-300-5886. That is 919-300-5886.
Great. Peter, thank you.
Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k, or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.